Welcome back to the deep dive. Today, we've pulled together a really fascinating stack of material financial articles, some entrepreneurial deep dives, and a lot of behavioral science research.
Yeah.
And it's all focused on this one incredibly frustrating paradox.
hmm
Why do high potential individuals, the highly paid specialists, successful entrepreneurs, the top tier income earners, why do they so often sabotage their own success?
It's such a huge blind spot, isn't it?
Yeah.
We just assume that if someone is making, say, $300,000 or more,
Right.
that wealth is just inevitable.
Right. It should be automatic.
But what our sources highlight is that high capital flow without serious behavioral discipline, it just leads to these systematic destructive patterns. They even call it the millionaire mindset antithesis.
And we are not talking about minor mistakes here. These are fundamental errors that act as systemic wealth destroyers.
Exactly. So we've organized this deep dive around three major vulnerabilities, three cardinal mistakes, if you will, that really hit the core of human psychology and financial strategy. We're going to uncover the financial trap, the time trap, and the emotional trap.
And our mission today is to give you the shortcut, the way to recognize and avoid these wealth killers immediately. So let's start with the most visible one, the money drain.
Yeah, let's do it.
So the first cardinal mistake, it's often called lifestyle creep, or I think one source called it the affluence trap. It's that constant kind of subtle failure to decouple your income growth from your consumption growth. You get the big promotion, the income jumps, and suddenly you feel justified in buying the bigger house, the fancier car.
And somehow you end up feeling just as broke as you were before. It's the financial equivalent of the hedonic treadmill. And high earners, they just tend to run on it at a very high speed.
That's a good way to put it.
And the sources are clear. The temptation to just instantly increase spending when income rises. That's the default. You have to actively design systems to resist it.
Okay, but wait, isn't that a bit harsh? I mean, surely someone earning several $100,000 can afford a new luxury purchase. Where do the sources draw that line between, affordability and true financial damage?
That's a great question. The damage isn't really about the purchase price itself. It's about the opportunity cost. It's this anti-compounding force.
An anti-compounding.
Now, think about that brand new car or boat. It's a depreciating luxury. So that dollar you spent is capital that is permanently removed from the compounding cycle. It's invested in a liability.
Right.
If that same money had been put into an appreciating asset stocks, diversified real estate, it would be working for you. Instead, you paid for something that is actively losing value from day one.
So you're not just spending $80,000. You're losing what that $80,000 would have become over the next, say, 20 years.
Precisely. And there's an actionable tip to counteract this. It's about being intentional. The sources suggest basing your current core expenses on what your income was, let's say, 2 years ago.
Oh, that's interesting.
Yeah, this ensures that any lifestyle upgrade is based on truly stable, recurring income. And it forces you to save that new surplus.
And it's not just the big luxury items. The research suggests a lot of high-income earners ignore basic financial hygiene just because they assume their high earnings will fix any underlying mess.
That's the paradox. They skip the fundamentals. They might scoff at the idea of a budget, but a budget is a tool for strategic deployment of capital. It's not just for people who are broke.
Yeah.
They ignore an emergency fund, assuming income is guaranteed, and then they get caught flat-footed by a market shift. And worst of all, they lean on high-interest credit cards for convenience, which creates this totally unnecessary bad debt.
And we also have to talk about complexity here, because high incomes often mean you have diverse asset classes. You might have self-employment income, rental properties, stock grants, and that complexity turns tax strategy into a critical defense point.
Oh, it's a massive pitfall. Failing to use optimized tax strategies means missing deductions, maybe incurring costly fines from the IRS, or just paying way more than necessary. For this audience, this is where the ROI of professional leverage is highest.
Right.
Outsourcing your tax prep to an expert, it almost always pays for itself. Not just in compliance, but by finding legal strategies the individual never even knew existed.
So we fix the drains, but then there's the other side of the equation, which is maximizing what comes in. And this is where we hit the under-earning blind spot.
Yes.
You could be making $150,000 and still be considered an under-earner in your field.
Absolutely. If the average for your skill set and role is $200,000, that $50,000 annual difference isn't trivial. It is a huge permanent reduction in your lifetime investment capacity. Earning power, your human capital, is arguably your most valuable asset.
Okay, so if that ability to earn is the foundation of the entire plan, how do you protect it?
Well, you prioritize health, which is foundational. But financially, you protect it with specialized insurance. We're talking about private disability insurance.
Okay.
Unlike the group policies offered through an employer, private policies often have better terms, they're portable, and they cover a much higher percentage of your income.
Mm.
You have to protect the goose laying the golden egg. That is foundational wealth preservation.
That really grounds the point that earning more doesn't solve poor financial hygiene. But speaking of time, that brings us to the next massive wealth drain, the time trap. This is all driven by procrastination and inaction. And when we procrastinate on financial tasks, the costs just become exponential.
Well, the behavioral research is damning here. 72% of people admit to procrastinating on things in general, but 75%, that's three-quarters of us, have put off key financial activities.
Like what?
Creating a budget, setting up an emergency fund, or organizing retirement savings. The basics.
And the emotional cost of that delay, it seems almost as bad as the financial one.
Yeah, it is. Over 60% of procrastinators estimate a tangible financial loss, but 41% feel stressed out, and nearly a quarter feel shame when they delay these tasks.
Oh.
And what's really interesting is why this high-potential audience delays. The data suggests millennials often delay out of anxiety and perfectionism. 39% worry about not doing the task perfectly.
And that anxiety leads directly to analysis paralysis. The high earner overthinks every single option until they make no choice at all. They're waiting for the perfect moment.
They get stuck in the perfectionist freeze. We often see individuals who have substantial sums, $100,000, sometimes up to $300,000, just hoarded in low-yield savings accounts.
Which are actively losing money to inflation.
Exactly. They're going backward. And that money just sits there because the owner can't decide between option A, B, or C, and they forfeit the one irreplaceable asset they have. Time to compound.
So if you're paralyzed by options, what's the immediate imperfect step to take?
The solution is aggressive imperfection. It is so much better to invest today in a simple, low-cost, passively managed index fund, like a VTI or a VOO, than to wait another 6 months for the perfect market. Action now trumps perfect strategy later. Every time.
And when you look at the raw power of compounding, the cost of that delay is truly irreversible. Can you walk us through the starkest example in the materials?
Okay, this is where it gets really important for you to internalize this. Let's look at two investors. They're each putting in $100 a month. Investor A starts early and invests for the first 10 years, then stops. Total input, $12,000.
Okay.
Investor B waits 10 years and then invests $100 a month for the next 40 years. Total input, $48,000.
Wait. So investor B put in 4 times the amount of money.
4 times the money. Yet after 50 years, investor A, the early starter, ends up with nearly $20,000 more wealth than investor B. That small amount of early capital captured the exponential growth phase. The message is absolute. Time in the market is superior to timing the market. You just have to act now.
That data is just staggering, but it highlights that disciplined action is what matters, which I think leads us directly to the third trap, the emotional roller coaster.
That's right.
Our sources dive deep into behavioral finance here, which explains how our own biology betrays our best intentions.
It really is the battle between your two brains. You have the reflective brain, which is rational, analytical.
Right.
It's the one that builds that long-term investment plan.
Right.
Then you have the reactive brain. It's emotional, it's primal, and it is hardwired to avoid danger or loss right now.
And when volatility strikes that sudden 10% market drop, the reactive brain just takes over, right?
It absolutely can overpower the reflective brain. This is why fear causes people to sell assets when prices are low-locking their losses. And greed causes them to pile into assets when prices are high, often just before a correction.
It's pure emotion.
Pure emotion driving the investment decision, not logic.
I find that concept, the reactive brain, just shutting down the rational one, genuinely frightening. Is there any way for a high-potential person to preemptively train against that psychological takeover?
Yes. And it's by setting up guardrails and pre-committing to discipline. We'll get to that. But first, let's just look at the financial damage. Because this emotional behavior, it quantifies into massive underperformance.
Okay, tell us what the data shows.
Over a 30-year period, the average equity investor underperformed the broader market by an average of 2.14% annually.
2.14%.
Every year. The market might have returned, say, 10.15%, but the emotional investor only realized 8.01%.
And over 3 decades, that gap.
It translates into hundreds of thousands of dollars lost just to behavioral errors, just from buying high and selling low.
That is a staggering data point. It means the biggest enemy isn't the market, it's the person looking back at you in the mirror.
It really is. So what specific behaviors should you avoid? Avoid chasing trends. They're usually played out by the time you hear about them. Avoid trying to time the market. It's an amateur move that even the pros fail at consistently. And crucially, avoid trading too often.
Why is frequent trading such a killer?
It creates a transactional drain. You're incurring higher commissions, higher fees, and crucially, you trigger higher short-term capital gains tax rates.
Which can be nearly double the long-term rate.
Exactly. So those drains, they just quickly erode any marginal gain you might have made. You're basically paying for the privilege of making emotional mistakes.
The behavioral fix then is simple, even if it's really hard to execute. Stick to the long-term plan.
Rigorous adherence to diversification and a long-term plan is the only defense. Look, the history is your armor here. 100% of all 10-year periods in the S&P 500 index have yielded positive returns.
100%.
When the market drops, you have to remember that data point. Trusting the long-term trend defeats the short-term urge of the reactive brain.
Okay, so now let's pivot from the problems to the practical solutions. A key strategic error, I think one source called it financial mistake number 7, is the delusion of trying to do everything yourself.
Yeah.
This is especially true for high-potential, intelligent people who think they can master every single field.
High-potential individuals, they often confuse intelligence with infinite time and specific expertise. They fail to apply the principle of leverage to their own knowledge base.
What do you mean by that?
Well, if you were an expert, say a specialized consultant, your time might be worth $300 an hour. So delegating a complex task like tax loss harvesting to a professional who charges $150 an hour, that isn't a cost. That's an immediate return on your time.
So outsourcing those complex, specialized tasks provides an ROI by closing knowledge gaps that you just don't have the time to fill.
Precisely. For entrepreneurs, this means focusing relentlessly on high-leverage activities like sales, innovation, and strategic growth.
Yeah.
They shouldn't be handling their own admin tasks or deep diving into complex bookkeeping.
Right.
Automate or hire help immediately. One source actually recommends hiring an accountant up front before you even hit 6 figures to build the proper structure from the start.
And this isn't just about financial professionals, though. This strategic edge extends into mentorship. The data here is fascinating because it proves mentorship isn't just a soft skill, it's a measurable multiplier.
The mentorship multiplier is a core tenet of elite organizational strategy. Think about the scale of it. 98% of all U.S. Fortune 500 companies have mentoring programs. 100% of the top 50 utilize them.
Wow.
They wouldn't invest that heavily if the returns weren't tangible.
And the returns are staggering. It impacts profit, retention, even career progression.
Oh, absolutely. Fortune 500 companies with mentoring programs had median profits more than double those without.
Double.
Because mentoring accelerates learning. It reduces costly trial and error, and it facilitates knowledge transfer. That leads to faster innovation and better decision-making at the top. And on an individual level, mentees have a 50% higher retention rate, and those who act as mentors are promoted 6 times more often. It's a reciprocal wealth-building tool.
Finally, what mindset shifts are required to maintain this kind of strategic edge?
It all comes down to adopting a true growth mindset. First, you have to commit to continuous learning. If you're not adapting to industry changes, you're becoming obsolete. Second, embrace failure. Successful entrepreneurs view setbacks not as permanent roadblocks, but as cheap, essential learning opportunities that build resilience and fuel the next success.
And networking, I assume, ties into all of this.
Yeah. Critical. Building a strong, supportive network provides guidance, emotional support during hard times, and really importantly, access to opportunities. So many major deals and investment opportunities happen outside of the public sphere. Your network is your access to that non-public knowledge, which is invaluable. So to reiterate our core findings, the path to wealth is defined less by how much you can earn and far more by strategically avoiding predictable points of failure. The avoidance of lifestyle inflation, of behavioral inaction, and of emotional trading. That is the non-negotiable prerequisite for success.
Right. So the core psychological realization for you, the high potential listener, is that disciplined structural action, whether that's setting an automated investment plan, budgeting around last year's income, or relying on specialized expertise, that is the necessary firewall. It's what protects your accumulating wealth from the emotional and behavioral shortcomings we all share. So here is the final provocative thought we want to leave you with. Historical data shows that over the last 82 years, every single 10-year period in the S&P 500 has yielded positive returns.
Every single one.
Given that powerful statistic that time in the market consistently and reliably beats timing the market, what one disciplined action, financial or strategic, are you still waiting for the perfect moment to start?